Hey everybody, welcome to Mortgage Today for Tuesday, August 1st, 2023, and oh, what a day it was. I'm back in the office, so my sound is probably a whole lot better. MBS were flat on the open. It almost never does that. Stocks were down 11 points. The 820 CME Open is such a relevant event for the bond market sometimes that it has its own entry in our knowledge base. On any given morning, it's possible to see traders lined up figuratively to buy or sell as soon as 820 hits. This is all the more likely on the first and final days of any given week or month. The overnight session saw a moderate accommodation trade with stocks and bonds buying and selling together, something typically seen when the market is adjusting its outlook for Fed accommodations or broader global monetary policy. That said, it wasn't pronounced enough to suggest there was some input that would change the Fed's stance. We did get news that the Reserve Bank of Australia was out with its latest monetary policy decision overnight, where it hiked rates by 25 basis points. We got the JOLT survey, which job openings were 9.6 million at the end of July. Hires decreased by 5.9 million, with losses experienced in finance and manufacturing. The quits rate, which tends to forecast wage inflation, decreased to 2.4% from 2.6% in June and 2.7% a year ago. This is evidence that the U.S. labor market is starting to weaken, although slightly. We also got ISM manufacturing came in at 46.4 versus 46.8 forecast. It was 46 previously. Prices came in at 42.6 on a 42.8 forecast. It was 41.8 previously, so both below forecast, but still increasing. Fannie Mae came out with its second quarter 2023 earnings. They were released this morning. Fannie had $5 billion in net income for the second quarter of 2023, with net worth reaching $69 billion as of June 30th, 2023. Wow, making $5 billion in a quarter. You would think that they could come up with more money to feed all those affordable housing needs, but apparently that money has to come from somebody else. Net income increased by $1.2 billion in the second quarter of 2023 versus compared to the first quarter. Rather than weaken in the face of steep increases in the Fed funds rate, the first estimate of 2023 quarter 2 GDP accelerated to an annualized seasonally and inflation adjusted rate of 2.4%, up from 2% in the first quarter of 2023 and down slightly from 2.6% in the fourth quarter of last year. Business investment and consumer spending led the way, while slowdown worries remain. Recession probabilities keep being reduced and the start of recession keeps being delayed, which is good news for the economy, not great for mortgages and the bond market. If the bond market is well understood to be heavily data dependent, and if today's big ticket economic data didn't come in stronger than expected, why did the bond market lose a fair amount of ground? Which is a fair question, to be sure, and in this case, one that isn't easily answered by making excuses for the economic data. Instead, it makes more sense to focus on new month trade flows and apprehension over the upcoming data in the event that the second half of the week with jobs and everything goes sideways. Net, the bond market was down 12 basis points on the MBS and up 9 basis points on the 10-year. Stocks lost 12.23 points. At the end of the day, the MBS are at 98.86, which is just below this 25-day moving average downward trend line and just above the blue Fibonacci S1 retracement line, so it's kind of the wide range that we've been trading in for about a week now. So we'll have to see if the new data, including ADP jobs tomorrow, confirms that range or puts us into a new one. We got some good news for MBS spreads. Mortgage REIT Two Harbors reported earnings and said that volatility has decreased. Mortgage REITs like Two Harbors are the buyers of mortgage originations, even though you might not see it. Lower volatility means that the mortgage rates should continue to decrease relative to movements in the 10-year bond, so the spread between the 30-year MBS and the 10-year bond should start shrinking a little bit, which is what we've all been looking for. The point about spreads remaining at historically attractive levels means that the mortgage rates have the potential to fall a little bit. Even if the bond market all stays the same, there's the chance that spread could tighten up. The month of July tallied 28 basis points of excess returns to treasuries, which makes it 3 months in a row that the index has pulled off this trick. So basically, the yields on MBSs are outperforming the yields on treasuries. Considering that July is traditionally a lousy month for mortgages with an average excess return of negative 5 basis points since 1988, that's good news for mortgage bonds. We also got a post from our sponsor at thatmakesense.com. The true measure of leadership is influence, nothing more, nothing less. This is from our Rene Rodriguez series from his great book where he talks about the reticular activative system as a system that says yes, listen, or forget about it. If you want to lead, if you want to influence people, you have to know how to impact the reticular activating system. Check out that on our sponsor at thatmakesense.com.